Have you ever wondered what the share market is and how it works? Today, we'll break it down in simple terms so that anyone can understand. Stay tuned till the end and you'll learn the basics of the share market, why it matters, and how it can work for you. Let's get started. Think of the share market as a giant marketplace, but instead of fruits or gadgets, people buy and sell shares. Shares represent ownership in a company. When you own a share, you own a tiny part of that company. Share are ownership in a company. Examples of popular companies like Apple, Tesla, and Google. Companies list their shares on the stock exchange to raise money for growth, and investors like you and me can buy those shares. If the company does well, the value of its shares goes up and you can make a profit. Why would a company sell its shares? It's all about growth. Imagine a company needs money to expand its business, develop new products, or hire more employees. Instead of taking a loan, they can sell a portion of their company to the public through shares. This process is called an initial public offering or IPO. IPO is for initial public offering. Example: company sells 1 million shares at $10 per share. The share market operates like an auction. Buyers and sellers meet, and prices are determined by supply and demand. If more people want to buy a stock, its price goes up. If more people want to sell, the price goes down. Price equals demand versus supply. Example: stock XYZ, demand high equals price $50, demand low equals price $30. Stock exchanges like the New York Stock Exchange NYSE or the National Stock Exchange NSE are platforms where these transactions happen, but you don't need to visit these exchanges physically. Online trading platforms make it easy for anyone to participate. Why invest in shares? Shares are one of the best ways to grow your money over time. When a company grows, its shares value increases. Many people invest in shares to achieve financial goals like buying a house, funding education, or retiring comfortably. Reasons to invest in shares: wealth growth, passive income, financial goals. Example: 1,000 invested in company A grows to $5,000 in 10 years. Apart from price growth, companies also share their profits with investors through dividends. Dividends are like a reward for being a shareholder. While investing in shares can be rewarding, it's not without risks. Share prices can go up and down due to various factors like company performance, economic conditions, or even global events. Risks in share market: price fluctuations, economic downturns, global events. That's why it's important to do thorough research and diversify your investments. Don't put all your money into one stock. Diversification can help reduce risks. Diversify, aka spread your investments across sectors. Step by step animation of opening a trading account and buying shares. So, how do you get started? First, open a demat and trading account with a trusted broker. Next, research the companies you want to invest in. Finally, start small and invest only what you can afford to lose. Step 1: open a demat account. Step 2: research companies. Step 3: start small. Remember, patience is key in the share market. Think long term and don't let short term fluctuations scare you. To sum it up, the share market is a powerful tool to grow your wealth if you understand how it works and manage your risks. If you found this video helpful, don't forget to like, share, and subscribe for more content like this. See you next time. Like, share, subscribe. Thanks for watching.